we're at the very front end of this, and we don't really know how this is going to evolve, but it's going to be much quicker than people think. And if you get involved in this at all, there's lots of good things. You get all this additional data and you get it quicker and all that kind of stuff. But fraud is going to skyrocket.
Hey there, it's Mike Langford. Welcome to another episode of the 6x6 Lock Podcast, a secure money movement podcast for the private markets. On this episode of the show, Todd Sorrel and I are joined by legendary investor Britt Harris. Britt is one of the only investors who has been a CIO for a top 5 investment fund in the 4 major investing categories of endowments, public funds, private funds, and hedge funds. And he recently launched a new firm on Eagle's wings to leverage simple, transparent strategies that are rooted in wisdom. And I tell you what, you are about to get an avalanche of wisdom in this conversation. Britt really brought the thunder, so make sure you buckle up and grab a beverage for this one. Now, before we get to the conversation with Britt, please do make sure you subscribe to the 6x6 Lock Podcast on Apple Podcasts, Spotify, Amazon, the YouTubes, or wherever you like to get your podcast jam on. And if you have a question or a suggestion for the show, hit us up. Shoot us an email, podcast@6lock.com. Okay, let's get to the conversation with Britt Harris. Well, Todd Sorrel, we are here with Britt Harris. So wonderful to meet you.
Nice to meet
Welcome to the 6x6 Lock Podcast. This is fantastic.
I'm excited to be here.
Well, you're a busy guy, and we really do appreciate you carving out the time, right? We were talking before we clicked the record button about like all the things you got going on. So I thought a fun way to kick off today's show would be, I jokingly call this the IMDb, Internet Movie Database, part of somebody's life. Like, tell us a little bit about your story, like how you got here and so forth. And I thought a great way to anchor it would be a quote from a previous podcast you were on. It's called the Scholars of Finance podcast. And if people want to check that out, we'll link it up in the show notes. You said something, I'm paraphrasing, but you said that finance isn't necessarily the most important space. It's not the most important, but it is the lifeblood of every other industry, every other thing you're doing here. And that, to me, spoke to like your ethos. Also spoke to a little bit of humbleness, the way you see this. But maybe you kick us off like,
most people want to have purpose.
Yeah.
And when you ask somebody in finance, like, what's the purpose of your work? And I had this asked to me one time. I said, like, what do you do? These people, made stuff in this. I mean, like, what do you do? And I said, I make money. That just doesn't come across as like, this is a really high calling. So the purpose is, why do you make the money? And so, I'm making money for retirees. I'm making money for, future generations. And we're in order to do that, we're supplying capital to companies, big and small, every kind of industry. And so you're right. It's kind of like they're the most important, and we're in service to them. But in order for them to operate well, they got to get this capital, and that's what either by investing in it or issuing, helping them to issue. I mean, it's absolutely critical. The economy couldn't operate without it. I mean, it's really the big thing about. We'd still be back in the dark ages, if this wasn't possible. Now, sometimes we get too much credit or too much blame, but we're definitely not the most important. But we're kind of like the facilitator on the team that. Like the quarterback, you need the ball, you need the ball, you need the ball.
That's right. Yeah. Word comes to mind is allocation. Yeah. You allocate resources, time, people, energy towards solving a mission. You can almost turn that conversation around to the person that asked you that question years ago of like, we fund you in a roundabout way. Money comes back to that. Liquidity is part of your business too. Especially if they're making something, manufacturing, whatever.
Yeah. So can I tell you the next question I got after that?
Yeah, absolutely.
They said, well, how do you make it? And I'll do this quickly. I said, well, we do some, and we hire people around the world to do some. And they said, oh, those are your critical suppliers. I said, not really. They're sort of necessary evils. And he said, what happens in the meet? He said, they try to tell us they're smarter than they are. We try to tell them they're not as smart as they are. And And when it comes out of your mouth, you're kind of like, that didn't sound great. And they said, well, is that really what you want to do? And of course, the answer is no. And after that, we started prioritizing, trust, people that we trust, organizations we trust. And, that organizational relationship between the two of us as collaborators rather than kind of competitors, started, and it was hugely beneficial.
So how do you, part of that question, I make money, but in that is you're allocating money, obviously, as you said, it's all about allocation, but there's a step before of getting people to entrust you with the money that you can allocate, right? You've been doing this for a while. You just started a new fund, right? Yeah. On Eagle's Wings, right? Correct?
That's right. Yeah.
All right. Obviously, probably not as much of an issue for you now because of your track record, but in the early stages, what is that process like for you to go out and get people to entrust you to be the allocator on their behalf?
Well, they have to get the sense that you're in it for them and not for yourself.
Yeah.
So I'll tell you,
it's an alignment.
Yeah.
Right.
A total alignment. And and that when it comes down between who's going to get the extra, it's going to be them. I'll give you a couple of stories. It was one of the relationships I had. Somebody called me in my prior fund, and I said, "Well, I'm actually going to be a new fund." It was a huge account, and so we'll try to develop an account for you over there. And we did. And it was a good account, but we were in competition with a huge bank and another big party, and we were relatively small compared to them. And so we developed a great account for them. When we came in, we just thought that was normal. We did the best we could on the account. And then we said to them, this is a high net worth individual. We'd love to manage money for you, but no, you should split this up. Somebody, two people, maybe even three, two organizations. About 2 weeks later, the guy calls me back and says, we're going to give you an account. I said, fantastic. Do well or die trying. And how much do you want to give us? And he gave, I'm not going to say the number, I guess. There's big numbers in the billions.
Yeah.
He said, well, we're going to give you that number. And I've never had this before in my life. I had to say, we're really happy that you're going to work with us, but this is not our recommendation. You need to split this up just for your benefit. And he said, yeah, we know you told us that, but the other two told us we should give it all to them. So you're the only one that we trust.
What a story there.
Well, that's a fantastic story. And
that's alignment. I mean, there it is right there. Like, you were sitting there saying, here, let me give you the best advice I can possibly tell you. Here's what's probably the best thing for you to take. This is the path that's going to work for you the best. They didn't hear that anywhere else. And that's, yeah.
I always try to when I'm talking to somebody, I said, what we want to do here is we want to find something that's fair and just, and it's mutually beneficial.
Right.
And that's not really the way the industry thinks normally. And so we will come up with what we think is fair and just. And I tell our guys, not some alternative version of fair and just that favors us, something that we really believe is fair and just. And then I'll say to you, if you can come up with something that's more fair and more just, then we will, we'll do what you want to do.
Right.
But we also talk about now when we're going to pay our way, but we're going to get every scintilla of value, from this relationship. So in some cases where people have different divisions and, and different, profit centers, I said, when I write my check, it has one name on it. And then I don't really care. It's the equity division or the bond division or the private equity division. I'm writing a check to your firm. And so therefore we're going to require, and you should want to give us, more service. When I started a $300 million fund, mm-hmm. I knew nothing. I don't know much now, but I really knew nothing then.
Your nose is growing.
And somebody I would say, we're giving out $20 million accounts.
Yeah.
And I would say, well, these big funds are giving out $500 million accounts. So what does that mean? And they gave the answer that was really good for the 20 million. They said, everybody gets the same products and services. Then I got to be the 500. It's kind of what?
Yeah.
So every person who works with, they need alignment, they need trust. You have to ask yourself on a Sunday morning or Saturday morning, because Sunday morning you're going to church. Saturday morning, Saturday morning you're in the grocery store, and you come down one end of the aisle in your Bermuda shorts, and they come down the other. Do they even recognize you? One. Number two is, do they recognize you and then sort of like back away? Or do they run towards you?
Yeah.
Right.
It's great. That's fantastic. What's really interesting is, without knowing it, you teed up our next topic, because we want to talk about the private markets as a handshake economy, right? How trust became private markets' biggest vulnerability. It's its biggest asset in some ways, right? Like, I trust you, like, great. You mentioned they were going to give you a couple $1 billion to go invest. And you're like, are you sure I'm the right person for it? I'm not,
I'm definitely the right person. Not all, not my organization is, but we didn't feel like it was right for them to give us everything.
Yeah. But it was like, what a great feeling of that type of trust. And it's wonderful, but also can be a vulnerability for the industry as well, right?
Sure. Yeah, no doubt about it. I mean, just the name of itself is private markets. There's a lot that people aren't going to see. It's not public markets where there are quarterly filings. The stock prices is every day. It's there. News is published. There's interviews with the CFOs and the C-level suites. Private's different. Yeah. There is a handshake. There's a trust there that you're going into. But private companies become public companies and grow and go public and have these awesome offerings at some point. So, yeah, I would just say private markets, it seems like it's just changed a lot recently. I think interest rates have made it where it's not cheap money. Multiple expansions are contracting now. It's more of, it seems like a disciplined era. Britt, what do you think about that?
Well, I'm going to start with the original questions. So remember, there's a thing called trust but verify.
Yeah. I think our
so
former president said that.
Yeah, Reagan. So I'm not going to work with anybody that I don't trust, but I'm a fiduciary, and I'm going to trust them because they have all the operations and the processes and the procedures, and they're personally trustworthy. Mm-hmm. It's got to be both. It can't be one or the other.
Right.
So in private markets, David Swinson, probably the best one ever to do this and introduce that concept, and me and a bunch of others sort of, followed that methodology. And when you and I were walking up, I said, every solution creates its own new problem. Mm-hmm. And so now, private markets has gotten, it'll be fine in the end, but right now it's struggling probably as much as it's ever struggled in the last, forever probably.
Yeah.
If they don't have a good year this year, it's going to be like the fourth year in a row. And part of it is what, the environment has changed. And we started an era in, let's say, 1980. Discount rate was 20%. Mm. Interest inflation was 15%, and there was not much, just kind of spawning. And then from that point, till 2020, it seemed like you're consumed with the day or the period, but it was just long one huge ski ride, down to the base. It was a long ride. And so every time you did a deal, pretty much, the next deal was a lower interest rate and a lower interest rate. And now we've hit the zero bound. And even though interest rates in a historical basis are still pretty low, remember when we hit the zero bound, we had the fastest rise in interest rates in history, just to kind of get us somewhere near. So, when private markets are, start out being leveraged buyouts. And so you're going to have to be much more careful, with the leverage. You're not going to get as much capital because of the rates. And so they're going to have to transition to I'm going to be, much more operationally focused. And remember the other thing, we used to have 8,500 public companies, and now we're down to 2,500 or 3,000. Right. Where did all those companies go into the bigger ones. And at the same time, and this is not, your grandmother's investment industry anymore. And when you go into these funds, the LPs, I mean, they are substantial, large, sophisticated funds. And when you go to, pretty much the top 100, you might as well be going to a really large investment manager. And these people are expert in what's going on. And just imagine now, 20 years ago, if you talk about risk management, it's kind of like, we have a correlation number somewhere.
Yeah.
And
diversification.
Now you have whole functions, devoted to just that one thing. Operations, when we didn't have private equity, we didn't have much operations. Now you have to have substantial, sophisticated operations, and it's a totally different world.
That is pretty wild to think about. It is funny, just as you mentioned, like the scale change, right? Having basically a third of the public companies that you used to have is just absolutely wild.
Yeah. Well, I think access is a thing too.
Yeah.
Yes. I meant to talk.
Yeah.
Go ahead.
Yeah, absolutely. I was just going to mention that the LPs, like we can talk about institutional limited partners. We can talk about family offices, high net worth individuals, and so on. But they have access now. They're reading all the same headlines. They have access. The intelligence that they can get their hands on and read and go through. They're just as astute as a lot of managers are, because like they're paying attention, and they have a lot of people just coming at them. Like they don't have to. Do they have to approach anymore? Yeah, I mean they have people coming at them saying, sharing a lot of data and around what they should be doing or what they think they should be, or telling them what to do. So there's that too.
Yeah, and so that's an interesting point, because one of the things I try to preach is, like, if you're dealing with an organization, they know themselves. They are very deep, but they're not wide. And somebody, my kind of job. Like, you come in and you tell me the best thing you do, and then you come in and tell me the best thing you do, and they come in. And so at the end of the day, I've got 10 people telling what the best thing they're doing is, of which I'll cherry pick. I'll take one from you and one from you and none from you. And
yeah.
And, you really have a chance to be the best of the breed. And you have power, as an LP, because if I ask you, like, give me, up to a certain point, like, what's your secret sauce? You will tell me. I'm not a threat to you. I'm one of your customers, and you'll tell me, and everybody will tell.
Yeah.
And then, so we get things wholesale, and then from that you sharpen it.
I love that. Okay, so let's get on to our topic number 3. And this is something that you've teed up a couple of times, Todd, and I think we can probably broaden it a little bit, but especially with Britt's expertise and insights, as you were just describing. Like, you have this visibility, you called it a wholesale visibility into the way things work. It'd be really interesting to hear your thoughts on this. Todd, you've often talked about, and I'm paraphrasing here, that private markets are stuck in or money movements stuck in the Telegraph era, right?
Yeah, sure. Yeah, just around the word wire, right? I mean, that takes us back to a time and place where, copper was strung out across the United States, and literally people got on one side and the other, and they ran a wire to communicate from one side to another, certain actions or information.
Right.
Yeah.
And so when we think about the private markets, I think a lot of the infrastructure there is lagging, right? So what's it going to take to change that, to get private markets to innovate a little bit more? You were kind of talking a little bit about this a few seconds ago.
Yeah. So let's just realize that it used to be 100% liquid, and now most funds are at least 30% illiquid, and many funds are 70% illiquid.
Right.
So when you're trying to do analytics, and you have $100, somebody runs it for you, one of the big services, and they're as good as we have. And they look at this beautiful risk analysis. And first thing I do is I look at, like, what the total is. So this is beautiful risk analysis, but it adds up to 70 and I have 100. What about that other 30?
Right.
You just identified, where my risks actually are or could be. And since it doesn't trade regularly, and that part of the world, there's a difference between somebody who goes into public markets. That person is going to be more quantitative. They're going to be more operationally oriented. They're going to know financial theory.
Yeah.
You cross over into this world, we're not basing anything on normal financial concepts. We're going out and buying companies, and we're either putting leverage on them and taking it that way, or we're restructuring them and taking it that way. So
Sure.
So there's no history. There's no history of data. Like if you go over here, I'm working with somebody right now. Our data goes back to 1906.
Yeah.
You go over here, and sometimes the data goes back to 6 a.m. yesterday, which means you don't have the kind of basis that you need to really make the best decisions possible.
Yeah. You mentioned one thing about the 30%. That's liquidity. That's illiquidity, actually. Is there a premium on liquidity today?
It's not what it was. And the premium on liquidity fluctuates anyway. But, as I said earlier, and these are great organizations, they're fine, but every organization, there's a cycle to everything. Mm. And so when there's illiquidity in normal situations, and I'm just going after it, but then you go after it as well, and then you go after it as well, and then everybody, and your mother goes after it, all of a sudden, the liquidity premium, because, goes down just in terms of the pricing. And right now, as everybody knows, they're really struggling to
That's right.
Sell things.
That's right.
They're having to use a secondary.
Well,
markets.
one of the trends that's kind of come up recently, good or bad, are the continuation vehicles.
Mm-hmm.
Let's talk about that for a second.
Nobody went into it to do a continuation vehicle. So let's just get started there. Nobody said, I hope we have
baseline.
I hope we have a continuation vehicle.
Yeah.
But you get to a situation where you sort of don't have any choice.
Yeah.
Or sell it, fire sale prices.
Right.
And, and of course, the other thing that means is the continuation vehicle, they keep the money, but they don't get any new money.
Yeah.
Because we need the money back to make the next investment.
That's right.
So
sometimes the capital calls don't stop.
Oh, no. If you look at the tail end
of the distributions become a little bit more separated.
Yeah. And so, there's many, like one of my former funds, like we're responsible for about 20% of the revenues that go into, the second and sixth biggest universities in the country. Yale does almost the whole thing. And so if you're not, we have these meticulous schedules. So I'm going to give you $100 and I'm going to expect to get so much, 3 years from now, 4 years from now. And we're 60% behind. It goes back to 2019, I think. And so thank goodness the secondary markets have got some viability now. They used to be, the biggest teas in the world. You can do all these great things, but you can't, it's not in volume, and now you can. And so when some of these really premier private equity owners are selling, because they have to sell for the reasons you're talking about, they're selling at 10, 15% discounts. And that's some of the funds that you think are the premier funds. Just imagine the rest. So and they're dealing with this environment the best way they can. But right now, there's a thing called extend and pretend. So, it means if I can just hang on one more year, maybe this thing will solve itself.
Sure. That's right.
But they've never been in this environment before because, obviously the longer they hold it,
Yeah. It just seems like a buyer beware on who's buying those secondaries.
Yeah.
It's because you're not, those aren't great assets typically.
Yeah. It just depends on, yes and no. So I agree with you in general. Like if I'm trying to sell something on the secondary market, it's probably not my best stuff.
Right.
But the secondary market has evolved now. It's like, I'm not going to buy things that are not your best stuff. And if you really need the money, you're going to have to, upgrade, a little bit. Let's say at the same time, you're not looking at fantastic valuations over on the public side either.
Fair.
So, everything is down.
What are your thoughts on, things tend to cycle, right? They just do. So, we just started this part of the conversation talking about how, there used to be, 7,500 plus public companies. Now there's about 2,500, right? So it's kind of, contracted a lot, right? Consolidation, and a lot of that's due to the private markets, right? Taking companies once public companies into to the private domain. By the way, part of the strategy used to be, I'll take it private, get it right, maybe sell off some pieces, or just let it breathe and improve its profitability, its stability, whatever, and then we'll take it out to the public market.
There would be a reward there at some point.
That was usually that was the old strategy, right?
Sure. And you would try to get there as fast as possible.
That's right. That's right. And this reminds me, there's a last fall, the All In podcast had their summit out in Los Angeles, and there's some really great material out there on some of their speakers they had. I forgot, one of the besties was, they called themselves besties, by the way. One of the best, David Sachs in that group. I don't know if you watched. They interviewed the CEO of the NASDAQ, and it was great because it was just, there were fair questions, there were hardball questions. It's around this whole subject of, we're looking at X amount of public companies. It used to be X plus. Like, what happened? Why aren't people... Your regulations are too tough. It costs way too much to go public. The Sarbanes, the Dodd-Frank, all these, it's heavy with regulation and red tape and the reporting that has to come back, the compliance requirements. Like, what are we doing about this? Why can't we get back to early investors someday get rewarded by going public, on the market where liquidity is immediate? And where are we on that? And it was some great responses. I'll let the clips speak for itself, but it was really in a sense like we need to remove some of this. It's heavy and it's hurting business. What's your take?
Well, this all comes from the GFC, right?
Yeah. Fair enough.
And, banks, some of them had gotten over their skis.
Right.
And so, we don't just let's say it's from here to here, and we're over here, we don't just adjust back to the middle. We, go all the way on the other side. So, banks now have legions of people just to fill out paperwork.
Yeah.
Just legions and legions of people are trying to do it. I remember we were talking about the energy transition. Jamie Dimon came out and said, well, we can probably do it, except it's going to take 18 years because of the bureaucracy, the rules and regulations. You can have all the solutions, but we can't get the approvals.
Right.
And you just see that across I'm not saying we don't need any, but what I say to our folks is I don't believe in pre-options. And what I mean by that is we need more regulation. And you get to something that's kind of, it's 6 one and a half dozen another. You say, well, why not do it anyway? Like, you're not doing it, but everybody else is doing it.
Right.
And they took a lot of free options.
Yeah.
That kind of leads us into our next topic pretty strongly, in that I imagine that LPs are starting to rethink their relationship with private markets, particularly with general partners, and what they're going to expect of them. You've talked about liquidity dynamics changing dramatically. We talked about the logical exit and return dynamics changing, pretty dramatically. What are your thoughts on what the LPs of the future are going to start expecting of their GPs? Is there anything different that you see coming?
Well, the first thing is you're going to see much more professional oversight. And I don't mean micromanaging. And I think this latest situation has kind of woken the boards up. Like, this was supposed to be a one-way street. Everything is great all the time.
Yeah, fair.
And also it was just a practical thing is, let's say that you have 100% illiquid and you decide to put 30% in 100% liquid and you decide to put 30% in illiquid. That's going to be a 10-year process, at least. And so I think one of the things that the private equity group is, they got used to that. They didn't realize not to just putting all this money out there. It's kind of like, I'm trying to get to 10% or 20% or 30%. So you have this huge natural cash flow coming in. It doesn't even matter kind of what the environment is. I'm not at my target. And when you're going from zero to your target, the most important thing is finding new managers. That's the big skill, like finding new managers. Like a baseball team, I'm trying to find a first baseman, second baseman, third baseman.
Yeah, you go down in the farm league.
Yeah, and so eventually you have your team, and you're at the funding level that you've targeted. So all of a sudden, the key skill goes from picky do managers finding new players. Like I've got an all-star second baseman. I don't need another second baseman. To rationalizing your system and then going deeper with the relationships that you have. And, co-investing is now, 20 years ago, there wasn't much co-investing because they gave all the co-invest to other private equity firms. And then the customer said, well, why are they getting this, So number one is, it's not a perpetual growth mode. And so the private equity firms are now, I call it reverse relationship management. Instead of just trying to find you, now it's kind of like, I want to maximize my relationship with you and so on. And it's going to get more mathematical in a way, not in terms of necessarily picking funds, but the record keepers and all these kind of things, they're just going to have to massively, enhance their game because they don't have this right now. And when I've run some of the best risk management systems that are available.
Yeah.
As I talked about earlier, they really struggle to sort of get this part right. And I don't think anybody's there yet.
Yeah. Yeah. Are targets being reevaluated too? Are we in an era of saying, the expected ROI or benchmarks levied across certain asset classes? Is there a reset on that right now? Are investors or LPs taking a step back and saying, wait a second, I think we're just in a different era right now?
Well, that's two. I have two minds on this. Number one is you always told me you could make 15% net. And I want to emphasize the net part.
Right.
And some people did and some people didn't. And now, there's just so much competition there that I think people have lowered their expected returns to 11%, 12%, even 10%.
Okay.
And of course, as long as they're believing that the public markets are overvalued, so let's say you're at 15% for private and you were 9% for public. Well, now some people have got 7% for public or lower. And so if you're dealing with the spread, the spread's the same, but the absolute number is lower. I'm sitting there saying, I don't really care about the spread. You told me you can make 15%.
Okay. So absolute return.
You have to deal. It's one thing, like you have to sort of do both.
Okay.
And a lot of people are instead of saying, I'm just going to do something, in one asset class with you and you and you, just think about how many funds, if you go back to the 90s, they were one fund, one category. They were privately held and they weren't global. You look at those same funds today, they're multi-funds, they're global, they're public. And so therefore, this is a big debate. Like there's the one-stop person that has one fund, one product to offer. And then there's funds that have multiple products to offer. And so we will have a place for we call them rabbit hole investors. Like, I'm going to give you money. Probably not going to see you again for 10 years because that's kind of not your game. But when you come up out of the rabbit hole, you better have a lot of money and others that you're going to collaborate with.
Do you like those investors? Do you like the rabbit hole?
If they come up with a lot of money, I do. And a lot of them do.
Yeah.
A lot of them do. The thing that I think is important in any relationship is, out of sight, out of mind. Because if you're the CEO or CIO, I'm trying to learn from you. I'm not trying, like you're an information system for me. And I've got people all over the world and they're investing for you, but they're also feeding back information. So you get a mind share.
Yeah.
And you always have to ask if there's a real problem, you're going to think of 3 or 4, 5, firms. And I always want to be on that list. And some people don't. It's kind of like, just leave me alone.
Sure. Yeah. Fair.
And as long as if that helps them, be a good investor, then
right.
It's fine. There's plenty of room for them. But if you're a big fund, they can't fill the whole.
Yeah.
Fair enough. Whole kitchen sink.
That got me thinking about On Eagle's Wings. Tell me a little bit about that. Sorry, Mike, I'm a little pivoting.
No, that's good. I like it.
Britt, you spent a large amount of your career serving Texas teachers and other constituents, really more kind of in a public nonprofit sphere. You're really shifting gears going over here at On Eagle's Wings and serving for profit. The goal is to make funds and have great returns for your investors. Tell me a little bit about the switch on that. Those are obviously two different ideologies.
Yeah.
Those are different motions. Those are different organizations. Tell me a little bit about that, how you're thinking about that, and tell us about On Eagle's Wings and your excitement. When I talk about it with you, you light up a little bit, which is awesome. And I think part of that too, you get to work with your son and the organization, which is really cool.
Yeah.
I have two boys, and man, one day if I had a chance to work with one or both, it would
when you see
be
them
great.
grow and mature and become actually professional, it's a pretty nice thing.
Paying taxes too.
Yeah. Yeah. So I made several transitions in my life, and I started this in 1986. So it's hard to find somebody who's started before I did. So I've actually been a participant in all these evolutionary changes, and sometimes part of the cause of it, for better or worse. So the first one was, and this is going to get a little philosophical. I think it's important for people it's a good concept for people to know. The first one was, I was taught a concept of success is not the top of the ladder. When I was in my 30s, there was a man named Bob Buford. He actually wrote a book called Halftime. And he had a bunch of young people, and he said, success is not the top of the ladder. And we looked at him like, well, let us find out first. and he said you should divide your career into two parts. The success part, which is, this is for arbitrary reasons, from start to maybe mid-40s. And that, you're finding somebody to marry, you're having a family, you're becoming a good father, a good husband, you're developing a skill. You can become an expert in something, you get some resources, you make mistakes. And just like a football team, then you say, okay, let's go into halftime. And then when you get into halftime, you sort of count your blessings, like here's all we've been given and here's all the things that happened. And, it's really good to take account for, we're always thinking about the next thing and we're always worried about the next thing. Gratitude is what will reduce your worry. And then so
that's a great concept right there.
Yeah.
That's just good to pause on that. I'll repeat that. Gratitude reduces worry.
Yeah. That's the only, if you're anxious,
right,
then you're not grateful. That's a harsh statement to make. It's just a fact. You cannot be anxious and grateful simultaneously. It's a scientific fact. And I'm anxious all the time, but at least I try to be self-aware. I'm anxious. So that means I'm not grateful. And I want to be grateful, not anxious. So you try to pull yourself out and think, well, what an amazing wife I have. What my kids are. I get to be here with you guys. Look at this view. Well, man, how can I not be grateful? Sure. And it is the only antidote to it. Mm. So let's say you ran the ball in the first half. It's football terms. Yeah. Julie and I went into this halftime experience, and so now we're thinking about significance. Doesn't mean you're going to stop. You might, but it doesn't mean you have to stop being successful. But for us, it was to leave the private sector and go into the public sector. And I think it's the investments are the same, but the environment and the mode of operation is much more difficult, in the public sector than the private sector. And I didn't really realize how, it's not better or worse. It's just not the same. And so you have to learn a completely different skill, to be effective in the public sector. So for instance, if you're the board in this private sector and I come in and say, I made this return, I beat my benchmark, I would live within the risk parameters, I steward the resources well, and you think I'm great. You say that to a politician and they think, well, that's fine. Why are you here? Because they count, and it's just, their measurement stick is power. So, they're not efficiency oriented. They're not, performance oriented. They're like, there's three of us. Right now, two of you are party A and I'm party B. Success is that next time around, there's two of me and there's one of you, because the whole agenda goes. And so you have to, when you see this, you have to say, well, my way is the best way. And so you just have to adapt to me. Try that, see how that works out for you. The better thing is to learn their language and, get to the right answer that you wanted before. Like you wouldn't go to Italy and speak English only, louder.
Right.
So, so success is significance. That's a really big thing. And your life and significance is so much better. And you want to have a great company. You want to have a great organization. You want to serve people really well. And also, we're getting to an age where people are living longer. It's not an agricultural society. And so you get to 65 and we're not physically broken down. Like I can still live. This is about all I need right here. And
Yep.
and so there's now emerging this philosophy about, should I just stay around? I'm still fine. And people reach different conclusions about this. My view, and it's personal, it's not, you guys could, it's completely different. I think the older guys should move on because every single person in their organization is stuck, until you do that. And, we brought people in to take over. So I was leaving UTIMCO. Now they because I was 65, they got this very nice, they made this huge press announcement saying Harris is retiring. And I said, who? When did I say I was retiring? I just said, I'm leaving UTIMCO. It used to be you retired at 65, you died at 66.
Yeah.
Now if you
Happened to my grandfather.
Yeah. Yes, I'm sorry. Now you get to 65, there's a good chance you're going to get into your 80s. It's kind of completely different. The thing that's, it's now not how strong you are. It's how, now the premium is on wisdom. And so you're actually the wisest you've ever been, at 65, but you run the mile in 45 minutes, and so, and this is a wonderful, industry to be in, and I have some expertise. So it gives you the freedom to do things the way you want to do it. What you think is absolute best. You turn your whole life. So, I have a 3 cheeseburger life plan. For everybody's benefit, the bun, I have to strengthen my physical life and I have to strengthen my spiritual life. If that doesn't happen, then everything inside is not going to work. And so inside, is my wife and family. When let's just admit it, guys, when you are successful, they don't say, oh, this amount of incremental success and you get 3 more hours in a day. This amount and you get to stay home more. It's exactly the opposite. And so, I'm trying to give back my wife the time that she deserves and has always wanted. And I've wanted to give it to her. Just, there's just so many things going on. The second is I have these classes that I teach at UT and A&M called Titans. It just produced, right now it has 1,100 graduates. They're all over the country. 43 companies have been created, $6 billion, 43 marriages of Titan men and Titan women. Remember, we're talking about significance now.
Yeah. Right. Significance. Yeah. That's right.
Yeah. And then the third is to start this company on Eagle's Wings. So there's lots of roads to Rome. But, one of the things that I think about is Pareto principle. Like 20% of what you do produces 80% of the results. And it's very easy to get. So I think most of us do it the other way around. Because the really big things are events and, your strategic plan or, there's a horrible market and you're trying to fill in the time, between those. I'll take a caveat here and say there are two things you need in investment. You need high IQ and you need courage. And most people have one, but not both. So during that period of time when nothing's going on, you need high IQ. But all of a sudden, when you have these huge, massive shifts,
right,
you need courage. And there's a lot of people with courage who don't have a super high IQ, and there's a lot of people with super high IQ who don't have any courage. And so, there's certain things that work and certain things that don't work. So number one is we're not going to do the things that don't work. That's the things that do work are how you allocate your assets and how you deal with bear markets and bubbles. If you look at the total effect on your fund, that's going to be 80, 90%, those three things. But we spend 50, 60% on that last 10%. So we're not going to do that part. And there's we have the efficient market hypothesis, and we have these long-term numbers. We have a strategic asset allocation that's meant for the long term, 10,
Right.
20 years. And that is good. I was there when that's kind of came out and it's kind of, oh, look at this. And then, we have some discipline. You push your equity and then your privates out as far as you can stand, and then you rebalance to that. And we call that optimal.
Right.
It's optimal if you're looking from 20 years back. But markets go through down markets, recoveries, expansions, down markets, recoveries, and expansion. So the epiphany is, you may be optimal 20 years looking back, but you're not optimal at not even one day along the way.
Yeah.
Not even one. You're the least far away from suboptimal. And that's all we've been able to do.
Yeah.
If you talked about deviate from that, it was like you were giving up your religion or becoming a communist or something. And it was right. It was right to do that because you had to forecast everything.
Mm-hmm.
So we have a way of based on lots and lots of historical data that you're not going to have to forecast anything. I'm just saying, look, you've been here a bunch of times in the past, and here's the data from that, and your portfolio is not optimal.
Well, yeah. And today we have a tool called AI that can take all that data and more data and more data and more data and simplify, as we talked about on the way here, just taking complex things and making them simple, how hard that is, right?
Yeah.
Making simple decisions going forward as a manager using the complexities of looking back with formulas or algorithms or whatever is hard. But this AI tool which is becoming ubiquitous, I think, across the board and leveraging it in some ways. Right. It's just whether it's operational, whether it's actually in decision making for allocation of certain asset classes or not. But it's not going away. We're all using it. Mm-hmm. It's how we're going to use it.
Yeah. So this, what I'm talking about, may be an extension of the efficient market hypothesis.
Yeah.
Because this is our long-term asset allocation, and I don't want to hold anything else because it requires fancy algorithms or guesswork or forecasts. We just have this unique information now that says you can say it that if you want to, but we've been in this scenario 500 times, and that is not the right allocation. And people choose to take it or not take it. We've been up and running for a couple of years, and our usually back tests have lower numbers, both lower returns and higher risk, but we've had higher returns and lower risk. So
fantastic. That's great.
I should say one other thing. We're trying to operate exclusively on biblical principles. Yeah, that's because that is where the good principles are. And I tried to do I'm going to write something about people operating biblical principles and successful people who don't. And it turned out I couldn't write it because the successful ones are using biblical principles. They just don't call it the same thing.
Interesting.
For those people in the audience who may not be have a lot of biblical principles or think of themselves as religious or having a deep connection to the Bible, how do you connect biblical principles as you see them to a more secular investor's perspective?
Well, let me say, number one, there are two characteristics of super successful people. And you may have some others, and you may have some that are different. There are two that everybody has. Number one is they're prolific readers. Number two, they're highly curious people. And those things kind of go hand in hand. So just to be a prolific reader, the Bible is the most read book in the history of humanity. Some people agree with some people don't. Some think it's sacred, some people don't. But it is the number one book that's ever been written in terms of wisdom. Or somebody might differ that. It's in the top 10. And so if you haven't read the Bible, you've really shortchanging yourself in terms of access to wisdom. And this has been around forever. So, and I'll just give you one example. There's a Sermon on the Mount, Beatitudes in there, and this is Jesus' longest oration to humanity then and through time. And as he brings it in for a landing, he has this verse that says, do unto others you have them do unto you. Do unto others you have them do unto you, the golden rule. What's the probably the number one, what's the one thing that's in everybody's culture if they're business people? Put your customers first. Deal with your customers. And that's a biblical concept, and it just goes on and on and on. We just have a different name for it. And so you're getting access to all that wisdom. You're also seeing, don't go this way. You want to talk about morality or ethics? Talk to a devout Jewish person. I mean, they have more morality and more ethics in the way they read the Bible than anybody else. And so I would just think you should read the Bible to become a wiser person. You can read other things too. You read Aristotle, you read Plato and all that kind of stuff. But if you look at the people, I've known so many people who are great people. They're not necessarily, Christians or Jewish, but they're great people. Most of them have read the Bible, and they quote it all the time.
Sure.
Interesting.
Right.
I'm glad we explored this, and again, for the members of the audience, whether you're religious or not, is having some foundational principles that you adhere to that guide how you go about investing or go about running your business is incredibly important.
Yeah, because if you don't have those first principles, that scaffolding,
Yeah.
when you get out into the future and something happens, you have no mooring.
Yeah.
And you're just kind of grasping at straws.
It's fundamental.
Yeah.
It's fundamental. And as you go into the marketplace and build and serve customers with product or a service or something like this, I mean, your company's architecture is built around this. This is the ethos. This is what everyone buys into and believes. But they believe in it because they see the leader act this way. They say certain things and they're buying in. So we talked about alignment at the very beginning. This is alignment too on, just core principles.
Let me give you another example. I learned from Ray Dalio that culture is important. Now, there's different kind of cultures you should have, but you need to have a culture, and it needs to be extreme. So everywhere I've ever gone since then, we're going to have a culture. And normally, they start with what kind of culture do you want, and then I'll add to or modify it. But in the last 2 years, I decided there's something so important that I said, I'm going to just put it in now and see what happens. And it's 5 words. Speak the truth with love. It's a biblical, right?
Yeah.
Speak the truth with love. And it has been so popular. It's unbelievable.
Yeah.
How popular it is. It's 5 words, but it's three different things. And we all have a problem with one of them. Do you speak? That's where the biggest problem is. Do you speak? And, if you don't speak, we're not clairvoyant. We need you to speak. Now, some of us need to don't take all the air out of the room so they have time to speak. But I don't want to put too much, because everybody puts the pressure on that person.
Yeah.
The people who don't speak have got to find a way. Number 2 is, do you hold yourself accountable for truth?
Yeah.
So we'll have our people say, when they're giving a pitch, is this your story or is this a fact? And because we're interested in your story,
yeah,
but we're not interested in hearing somebody's story expressed as a fact. Everybody's going to speak. You're all going to when you start, you're going to tell us, is this your story or your fact? And with love. So can you imagine if you had every single person in your company did that, spoke the truth with love? You could go in any industry and you would just kill it. What if we applied speak the truth to love to our government?
Sure.
Oh my gosh, it would be totally transformed.
Yeah,
Right.
yeah, that's right. That's right. I love that saying. Yeah, that's fantastic. And that's a sentence that you can build all kind of cultures around that. Right?
It's fantastic.
That's the bonus.
I love it. That is the bonus. Okay, I want to wrap up with what, and you started, you touched on this in a fantastic way, and I think this would be a great way to wrap it up. Would be to, you decided, hey, listen, I'm not retiring. I'm still passionate about this. I'll change my focus. I'll evolve. I'll look at other areas of interest, right? And at one point in time, that interest was you becoming an advisor for 6 Lock.
Yep.
As you mentioned, you got your start in 1986. So you've seen a lot of things. What was it about Six Lock at this stage of your career where you're like, not only is this something that I'm interested in, but I want to be involved in. I want to have a voice and help guide what they're doing?
Well, I don't think it takes rocket scientists to realize that the need for this kind of information, semi-real time, used to be zero, and now it's large, and it's going to get bigger. Just the fact that all of a sudden, everybody seems 30, 50, 60% in private markets, and that has never been a strength of the operational industry. It's very difficult to do. And we're at the very front end of this, and we don't really know how this is going to evolve, but it's going to be much quicker than people think. And if you get involved in this at all, there's lots of good things. You get all this additional data and you get it quicker and all that kind of stuff. But fraud is going to skyrocket.
Yeah, and it has. And AI has supercharged it. And that's what keeps us anxious. So I need to be grateful more often so I can decrease the anxiety. But as an entrepreneur, we always live with a healthy level of paranoia. But that's our job, right? Our job is to be paranoid around the attack vectors that are out there today and the way firms are moving money and information. The days of emails and spreadsheets and uploads and callbacks and FTP files going to banks and portals and all of this, those are all vectors now that AI can come in and change digits because we don't all have all the digits memorized, and funds can be rerouted, obviously, to the wrong location. I remember one of our first conversations, Britt, here a year or so ago, was that we were talking about UTIMCO, kind of back office operations and things around money movement and such. And you were just like, Todd, we can never solve that. We just can never solve around like how to put identity and payments together. And he goes, but I think you really believed in us and you came on board at that point. We're super grateful and excited to have you on board. That was huge tailwinds for us to hear that from someone who's been in the business just a couple of years. But it's awesome. Yeah. And we are like Lewis and Clark, but now we're putting highways for people to come see us to say it is safe. This is the way you get out of the fray and to get on a platform where identity and payments are super easy and safe.
Yeah. I just remember getting a number of capital calls and that we got, these companies. And when I looked at the number, I thought, this cannot be right. Can't even be close to right. Like this is 10 times more, 100 times more than I thought it was. And
that's right.
And so just in general, we're playing catch up. And then as we go into this new AI age, we're going to have to really take a leap forward to get in front of it.
Yeah, totally agree. It's going to have to be a change in the way we think, the way we process information, tools we use. So that's going to be for public and private companies. This is adoption. This is for everyone.
Yeah, if I'm in operations and I hear this, I'm going, fantastic. My job is going to go up in importance.
That's right. Instead of chasing LPs for money or making calls,
which is so fun.
Well, hey, I know you're on the chairlift with your kids.
Yeah.
Can you verify these wiring instructions? So yeah, we're getting folks out of the fray of that. But like you were saying too, we're de-risking those financial teams, the CFOs, controllers, and all their associates that are around them working hard, especially on Friday night on a long deal to get it closed. They don't want to be on the phone call verifying digits. Well, and so. Yeah. That's removed now. So now they can focus on more higher value type of activities for the company, forecasting, budgeting, these cases. Anyway.
Yeah.
Awesome stuff. Well, Britt Harris, it's been wonderful to have you on the show. Thank you so much for carving out this time. You're incredibly generous with the time. We went way long, but all sorts of good stuff. So thank you, sir.
Thank you for having me.
That's great.
Appreciate it.
Britt, thank you. Appreciate you, brother.
Yeah. You too.
Awesome stuff. Thanks.